Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hi, Jim.
Danielle, the federal cabinet huddled up wondering or planning on what the next step for the Canadian economy should be coming out of COVID. Not that we're even out of it yet. What kind of steps do you think they should be taking?
Well, it's a very difficult position we're in here. As you know, the federal deficit has gone up tenfold in just the last 9 months. So it is a situation where we are printing tons of money and, borrowing tons of money, albeit at very low rates. So, technically, it's a good time if you're borrowing to invest in long-term productivity gains for the economy and to bolster up strength and resilience. The challenge is that a lot of the funds that are being advanced right now are just filling holes, so to speak. So they're going into consumption rather than investment or long-term technology or improvements that we desperately need. So it's a game of, how do we sort of support and prevent the collapse of the private sector, because we have so many small businesses in dire straits in Canada today, and not just in Canada. In fact, it's all over the world. But we've got 16% of Canadian mortgages in deferral as of July. Got another sort of 66 billion or so of commercial loans in deferral, and many of them are in the hard-hit areas like oil and gas and the transportation sector, retail, tourism, commercial real estate, those areas. Commercial real estate's in a secular shift. As you know, with the exodus out of downtown, a lot of businesses closing office space or not renewing leases, paying big penalties just to get out of them because they no longer see the need long term for having that many people working in concentrated spots. So there's so many dislocations going on across the board, and the government is really not equipped to figure out solutions on the micro level. They're just trying to keep sort of floating the system with capital. But at some point, it's like the monetary authorities saying they want to keep rates low for the next 3 years, as the Federal Reserve did yesterday, and the Bank of Canada will no doubt follow suit. The issue is that when rates have already been low, already been zero for a long time here, when people are already up to the roof in debt, when they aren't getting wage gains and in fact are losing jobs, there is no ability to meaningfully increase consumption based on more credit. So you can keep rates as low as you want, but the trend actually reverses in those scenarios, like we're seeing in other countries like in Europe and Japan that have had zero and negative rates for a long time now. What happens is that people don't borrow and spend more. They actually consume less and figure out ways to cut costs and actually have to build up their savings. So really, monetary policies hit the wall here in terms of the magnitude of what it can accomplish. At the same time, the fiscal policy is strained because governments came into this with, bloated balance sheets to begin with, and low rates is again sort of in that scenario not really going to help unless we can borrow on the government level to invest, as I say, in something that's going to promote our ability to be more efficient and to generate new areas of business, new jobs, that kind of thing. So I think they really have to think about short-term liquidity and how to keep people trying to be resilient and look for work and look for business opportunities. But at the same time, they have to be, mindful that they don't, for example, go around trying to take over all the struggling sectors. That would be a disaster. Bailing out the weak links is not always a good answer. In fact, in the longer run, it's a terrible answer, because what you end up with is all these zombie companies, or zombie households just living from one line of credit to the next. So a lot of these payment deferrals that have come in the last few months are going to be up for the end of that, in September and October. And unless the payment deferrals are extended even further, which is a very questionable strategy, because extended to when and for what purpose, and how, when are we going to see a return in the actual organic income side is the question here, and that's not clear. So as these deferrals come up, I think you're going to see a rash or a wave of bad debts, write-offs, bankruptcies, and as painful as that process is, it's essential. So one thing government shouldn't do is try and stall or stop that natural process from happening. It's the only way we're going to get any rebirth. It's the only way we're going to get, balance sheets back to an area where the debt is not just crushing all future capacity to consume and invest. So, one of the terrible trends that we've seen year to date as well as rates have come down is that, first of all, in the private sector, you're seeing a contraction in credit for the reasons I've just said. People are not either able to qualify for more loans based on their income, or they have so much debt that they have no appetite or ability to get more. But what's happening is a lot of the publicly traded companies are increasing their debt, and we've seen that. And in private equity, this whole push over the past few years has been these private equity firms either, buying a public company that's struggling, and what they end up doing is typically gutting it of cash, putting a bunch of debt on the books, IOUs in the till, as I like to say, and taking out the cash for the private equity owners themselves. And in fact, that's exactly what's happening. There's about 24% of the funds that have been raised in the loan market in the last, in the last month, say, has been to fund dividends for these private equity owners. So get this, companies are borrowing from banks who are looking for, loan business, thinking, well, most of these people have no ability to take on more debt. Oh, here's a company that, they're going to borrow money. But are they borrowing money to increase productivity and innovation for the future? No. They're borrowing money to increase dividend payouts, short-term kickouts to the owners. So all of this does is just make that mess so much worse going forward, because there's less strength left in the companies. There's more zombies walking around that aren't able to do anything meaningful in terms of, investment and productivity, and you've got just mounting debt everywhere you look. So I think some thoughtful regulation would do things like restraining share buybacks, restraining ability to pay out dividends when companies are in distress. I think that's obvious. That's a sure path to complete bankruptcy, and then more job loss. So there are some smart things that governments can do in terms of enforcing prudent behaviors and banning really destructive behaviors. But then after that, they really do need to let the creative destruction mechanism run its course. It's desperately needed.
We'll have more with Danielle Park right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, how many times has this happened to you, like at 8 a.m, where you get 3 or 4 phone calls saying somebody's using your credit card or that you've committed some kind of tax fraud? Please call this number and admit that you're committing some kind of crime and pay us an instant penalty. Does it feel like fraud, deceit, and manipulation are now becoming widespread business models today?
Yeah, I think many people connect with that, right? There's all manner of sort of really brazen fraud over the internet, but over, people having sold our information, all these social media companies having sold their contact information to various groups, and some of them very sketchy and actually fraudulent in purpose. And we are lambasted now with one effort after another to part us from funds. It's terrible for elderly people who, my own father was a victim of this, which is extraordinarily stressful for people, those that aren't that comfortable with the internet age to begin with, and they're sort of just trying to participate. When they're victimized like that, it can undermine their confidence in using technology going forward or any of those systems. It really preys on the weakest in our communities and the people that are very vulnerable to begin with. And it's just, I think, a sign of our times. I was watching, there's the new documentary on Netflix called The Social Media, and I recommend it. It really looks at, a lot of it is from insiders of these companies who have come to consciousness, so to speak, after they sort of started these models of how do you manipulate and extract attention, how do you shape people's ideas. They've really been focused on this, and then a few of them have woken up one by one and said, wait a minute, what are we doing here? Because we're really gone far away from a constructive business model to a highly destructive business model where, we're really consuming the trust, but also the strength of these people who we're selling their information. Obviously, we're not the customers. The customers are the advertisers who are targeting our hearts and minds. So, but that documentary really goes into showing how we've shifted in this social media model to one of predatory practice. That's the dominant model. And I think, it goes back to what do we want to do about that? It's only been about a decade that this sort of trend has been so dominant, and it doesn't mean we have to perpetually endure this type of abuse at every level. So there's certainly, there's antitrust actions that are proceeding against various companies around the world, looking at abuses and the way in which they control monopolies, the way it's anti-competitive, the way it's very negative for our economy, for our households, for businesses. So at the end of the day, I think, now is a time, again, what are we going to do out of this crisis? How will we use it? Let's be constructive, right? Let's figure out how to curtail very destructive business models and throw, light or love to the ones that will be productive. I mean, the food system is another one, right? There was another study that came out that shows that 40% of Americans are now considered obese. And the numbers aren't that much better for Canadians, quite honest. Certainly not in the UK. It's pretty much all the same. So one of the opportunities in this COVID crisis where we know that, vulnerability around, morbidity issues of, whether someone is obese, whether they have diabetes, heart disease, these compounding factors play a huge role in the vulnerability of the society to these various viruses. And this won't be the last one, right? So, while we're looking at how to develop vaccines and how to develop, social distancing practices and things that will protect us from these terrible events in the future, we should also look at why we're so sick in the first place, why people are so heavy. Why has this happened? When we were children, it was the abnormal person who was very heavy, not the, norm across all age groups. So when it comes to, for example, our children, what atrocity are we wreaking on the young population? Like, we don't know to what extent they are going to be able to, be effective workers and have children and carry the world forward when they are, already in various states of ill health as children. It's never really happened before. certainly not in the developed world. So there's an opportunity here to look at how we can improve, local farming, less chemicals, more fresh foods, tax the bad stuff. I mean, we've talked about some of this stuff before, but I guess when things are going okay, no one sees the urgency. I say there's a ton of urgency now, and again, it goes back to how can we fund all this sick care, and how can we keep our system functioning in a democratic way so that we can help people as needed. Well, part of that is by realigning some of these incentives.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, is the U.S. Fed's policy of continued low interest rates the cure for a slow or dying economy?
Well, it, goes back to what we've seen for the last, 10 years on this topic. Japan has been trying to create inflation by zero interest rates for the last 15 years. The Abenomics drama where they promised that they would do all these things to boost inflation and growth in the economy. And in 15 years, they only achieved an inflation rate of 2% once, and that was in 2008 briefly, just before the whole thing collapsed and they went into negative deflation again. So the fact of the matter is that central banks are not able to create inflation in an economy which is already chock-a-block full of debt and aging population, where you have such dramatic inequality of wealth and such concentration in small percentages of the population. And this is a theme that is not going to go away until we have greater spreading of resources throughout the economy so you can get some multiplier effect. This goes back to getting people out from under debt and into a net savings position so that they have the ability to buy things without having to cripple their future spending ability. So all these things really point to deflation. And, that means asset price deflation. And that includes things like housing. That includes things like equities and corporate debt, things that, we've never had the most, another study came out recently to say that since the 1850s or so, we've never seen, financial assets this extremely inflated, overvalued, since the 1850s. So we really are living in a surreal time in many ways. And that is because central banks, they're saying they're trying to create, inflation because they want to see prices gain, because with deflationary prices, if prices are going down over time, what ends up happening is you have a couple of impacts. It impacts revenues. It impacts profits for corporations. Typically, you don't get a rise in wages, so you don't get increased ability to borrow and spend, or to repay what you've already borrowed. And of course, with the world massively indebted, that's a terrifying thought for these financial engineers. But the fact is that we have this theme that has run its course so long, and now that yesterday's press conference was just another example. Jerome Powell is the latest head of the Fed, saying, well, they've been saying forever will be low rates for a long time, low rates indefinitely, lower for longer. And yesterday he said lower for longer and longer. We promise we won't raise rates. The fact is they won't raise rates at all so long as we continue to have these trends in motion. And all they've done is create asset bubbles which just billow and threaten. And when they burst, ultimately take people back years in financial progress. Savings deficits have never been higher than they are today. Pension deficits are massive. you've got a bunch of people moving into harm's way repeatedly and getting blown up repeatedly because of this idea that there is no alternative. You know, they've got GIC rates in Canada back under, you know, around 0.5%. They were 3% even a year ago. So we've really gone backwards in our ability to get to financial viability here. But the solution is not to drink the Kool-Aid and go into assets that make no economic sense and to put your capital in harm's way, nor is it to, you know, stay in your house as a speculative day trader, borrowing money on lines of credit or your CERB payments to risk it all in you know, being brave or aggressive or overly confident in doing financial gimmicks. At the end of the day, that's all nonsense. And not only does it not typically advance people over the long run, it typically blows them up and reverts them back so that they're in a worse shape than when they began. And that's been proven through centuries of human experience. So the best thing that people can do, instead of reaching for yield, instead of trying to manufacture magical tricks, the best thing they can do is look at their current living expenses and figure out, is there a way that I can do this more efficiently? Is there a shared living arrangement or a cost sharing arrangement, buying things with a community of people rather than individually? Is there any way that we can share resources so that we can all spend less and save more? The answer in most cases is just to keep working a bit longer till we get through this crazy period and or reduce your expenses so that you're not cutting through your capital at a crazy pace. If you're trying to retire and interest rates are minuscule, you know, you have to sort of recalibrate your thinking and say, okay, is there anything that we could do to not have to take out so much of our savings? Ideally, work part-time for a little longer, add to the pot some more. These are the things that will ultimately help in gaining traction and getting through to the other side of this period, you know, where conditions will improve. There will come a time when financial assets have corrected enough to be attractive as investments without, you know, insane levels of risk, where it will be rewarding, where you can collect dividends without having to risk life and limb. We've made some progress in REITs, for example, in Canada. They're still off about 29% from the highs. Energy companies are down about 50%. Financials are down about 20%. You know, so they're going in the correct direction. It's just that we're nowhere through this coronavirus train wreck yet, so to speak. And with monetary policy effectively spent, with, you know, fiscal policy doing all that it can, with the second wave is moving through much of the world right now. Europe and the World Health Organization is talking about this alarming rise in COVID cases around the world. In Ontario and Quebec, we've had more than 300 new cases a day in the last week. So we're kind of right back to where we were in about June. So there's no magic in this. You know, people start going back to school, back to work, shared experiences. They get fatigue about masks and social distancing, and the virus begins to spread again. And then, you know, Ontario went back to today announcing we can't get together in groups of more than 25 again, you know, down from 50, and you can't be inside with people beyond 10. And so we're back in the retrenchment as we head into the fall and winter here. So the economic problems are not going to go away, and in fact, the snowball of this debt problem that we brought into this financial shock is really just picking up speed again. So it's no time to be, you know, with wild abandon or throwing yourself into financial markets without really careful assessment of the risk and reward parameters that you're facing. But as I say, that doesn't mean there aren't practical things people can do for self-preservation and intelligent things they can do to get through this and be prepared for the opportunities on the other side of it. And so that's the best case scenario, I think.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.